Forex traders, you agree with me that in forex markets, there are uptrends and downtrends, and the market tends to move either to the upside or moving to the downside. When it's going up, it breaks structures to the upside, which means it's forming an uptrend, and if it's going down, it breaks structures to the downside, which is forming a downtrend. Now, the market doesn't just continue trending forever. You can agree with me on that. So if it's already going up, there's going to be a time where to form a balanced structure and to tend to come down, or if it's already going down, there's going to be a time it's going to form a balanced structure this way and goes up. Now, what do we mean by a balanced structure in this situation? It means a reversal is about to take place when it's either going up or down. And this video is going to teach you as a first trader on how to expect this reversal and know how to milk profit when the market is reversing. If you don't know how to reverse properly with the market, you're going to be losing a lot of money, and this is going to cost you a lot. As a first trader, you should be set to work with the strategies that I'm teaching you so I can learn how to reverse properly and make profits. So if you're in this video, do not watch the video to the very end. It's not going to be too lengthy, but it's going to be full with too much value. All right, so watch to the very end so I can understand every segment of it, and share this video with your friends if you gain insight from it. All right, so let's dive right into the video properly. Okay, so this is the option example. Now you can see the break of structure over here, the break of structure over here. Now, as usual, this is an uptrend. We want the market to continue going up, right? So this is what we do. We usually wait for the market to come here and then we enter for a buy trade as usual. But this time around, the market doesn't give you this uptrend continuation. It comes down here, okay, makes a double top pattern over here for pattern traders, reverses to the downside, okay, and after reversing to the downside successfully, it comes up back again and then start moving down. So the question is, what really happened when all this occurred? And let me explain what happened. The market successfully followed the ICT Trend Reversal Strategy. Now, when going up, it broke structures over here. It came down to this position, pulled down, went up again. Now, coming to this position we are currently in and reversing down to the downside, which means breaking structure to the downside, this structure to the downside, it means the buyers no longer have power to take the market up. Now, the power is left in the hands of the sellers, which are the bears in the market. The sellers pulled the market all the way down to this segment. Now, when you're in the market, you'll be seeing this market from this segment because you must have no entire trade yet. What you're looking for will be a fair value gap position or another bulk position over here that you'll be targeting for the market to get there. Okay, so you'll be expecting the market to come to a fair value gap position over here or another bulk position over here, and you'll be entering the market at a 50% retracement level of this other block of fair value gap position. So at the midpoint here, you'll be entering the market. So when you enter the market at this midpoint, you'll be expecting the market to pull all the way down with a risk to reward ratio of 1:2. So this time around, we are shorting the trade, and then we're having our stop loss directly above this swing high here, and your take profit is 1:2, targeting all the liquidity to this extent. So you're targeting 1:2 risk to reward ratio. Yeah, you can target 1:3 and just keep on going, but remember, the more you target, the more risk you take. So it's just best to stick with 1:2 and have proper risk reward ratio. Then if you want to manage your trades going longer, you can work with that. So this is a proper 1:2 risk reward ratio with an option example that gives you a sell trade. So let me edit this. So this is your option example for a sell trade. All right, so if you're still watching this video, it means you're already gaining a lot. I'll be showing you the down trade example for a buy trade shortly. So let's do this. Yeah, so you agree with me in the down trade. Our markets move to the downside, has a retracement going up, breaks this structure here, and continues that direction. So the more it continues, the more dark trends become valid. But there'll come a time in the market when the market can't continue like this, and the market will form a double bottom chart pattern here. So we'll see the market doing this kind of movement over here. So there'll be a lot of liquidity at the bottom here, because during this liquidity period is where the market makers will make a lot of money. All right, so let me identify the break of structures so you can understand what's going on and proceed from there. Okay, so this is the break of structure to the downside, break of structure to the downside. Now, when the market comes here, what do we expect in the markets? We can see that there are a lot of liquidity over here. Now, what does this liquidity entail? Okay, let me identify liquidity so you can understand what we mean by liquidity. There's going to be a lot of liquidity over here in the markets. So this is where our dollars will be. Yeah, so there's a lot of liquidity over here in the market. Why is there liquidity? At this moment in the market, there are buyers willing to go up, entering for a buy position over here okay, and then having their stop loss beneath area over here, and there are sellers willing to place a sell stop trading order over here, assuming the market continues to break to the downside and they will enter their profit. But this is what the market will do. The market usually comes down with a wick to take out all the liquidity, which means the buy traders are getting their stop loss hit, while sell traders have their sell orders open while the market just reverses to the upside. So it's more like it takes out the buyers and seller. You understand this completely once we open the charts. So this is a scenario showing the reversal going on. But before the reversal takes place, the market will come here. All right, it has formed this W pattern and it wants to go up, but it doesn't just go up straight. It comes up, then comes back to feel a level of inefficiency in the market that was here before. So what are we going to pick as that level? The level is going to be a fair value level or other block level or even a combination of the two over here in the market. Okay, so let me pause this here so I can show you the level. Okay, why it goes up. So let me show you what I'm talking about here. So there's usually a level of inefficiency in the market. The market comes back to fill, and you can enter a position here from 50% retracement zone in the order block of fair value gap. So somewhere around there, you have your buy limit order taking place there, and you can go in for a buy position or a sell limit order here taking it for this sell position here. All right, remember order block of fair value gap can be used in action here. So let's go to the charts and have real time examples so one can understand better how it plays out. Before going to the charts, let me show you how to work with a risk reward ratio here. Remember 1:2, you can also go for 1:3. But remember your stop loss is always beneath the liquidity here, and your take profit is a 1:2 risk reward ratio. So let's do this quickly. 1:2. Yeah, so this is a 1:2. But if you notice the market that there are more liquidity you can target at the depth side, you can target more even to 1:3, 1:4, depending on what you want to work with as a strategy. But 1:2 gives you more profit. 1:3 seems okay. Depends on what you're working with. But if you want to work comfortably in the market, you can work with a risk to reward ratio of 1:2. And since this strategy has higher accuracy rates of over 80%, you're still going to be in profit in the long run. So if you are consistent to 1:2, yeah, you should be enjoying the market profitably. So 1:2 risk to reward ratio is okay for you. And yeah, although you might miss up some more moves because market will keep on going up in some cases, for retracing, you know you've gotten your profits. So that's the main deal here. All right. So with this said, let's go into the charts now. Yeah, if you're still watching, you haven't subscribed, do it subscribe because I'm posting new video every single week, once a week, forex trading videos, the long content, and 2 short videos every week on our YouTube community, TikTok, Instagram, and those, and even on our WhatsApp community for signals and training. So basically, if you're interested in those concepts, you can follow us up for more tips. All right, so let's move on to the next step. All right, so currently we're on the charts. We're going to see how this example works here. So I believe from what I've been teaching you, you should understand that this is obviously a downtrend with a break of structure to the downside. You can see market continuously breaking structure to the downside, and we are currently here in the market. Now in a downtrend, we're expecting the markets to pull up and break structure down. But based on what we can see here, we'll be expecting to look for an opportunity for a retracement. So this example can be valid. So let's do that. Now, seeing this properly, let me delete this so we can work with the example properly. So seeing this properly, what we're going to do in the market now is to play this. I'm going to play it slowly and expect to see the market break to the downside. Now the market has this double bottom pattern, all right, or equal bottoms over here. Now this market went all the way up, started going up, but instead of going up completely, all right, it came back to sweep liquidity with this wick over here. So you can clearly see this wick. Let me show you if you can see it right now. So there's a wick over here. The market came to sweep liquidity with this wick. All right. So after sweeping liquidity with this wick, the market then went ahead to go up, came back, reversed into a level, and went all back. Now, which level did the market come back to? The market came back to reverse into a fair value gap position. If you're watching our videos, you understand fully well that the fair value gap is the space between the upper limit of a candle and the lower limit of the third candle. So basically, what I mean by that is that this is the first candle, this is the upper wick, okay? There's a space between the upper wick of the first candle and the lower wick of the third candle. So this phase is a fair value gap or a market level of inefficiency. Market usually comes back to fill. Now, working with this properly, if you continue playing this, you see that the market always comes back to refill this fair value gap before moving up. Let's not use the word always, it's the market. The market can manipulate itself. Let's say the market comes back to refill it. So what you enter in a position like this is a long position. Okay, so I'm going to enter long position. You'll be entering a buy position somewhere here. A stop loss is beneath this liquidity over here, this last liquidity swept, and take profit is a 1:2 risk reward ratio. So with a 1:2 risk reward ratio, you would have gotten in on this trade with profits. So I'm just doing this to show you how it have played out. You can see TP smashed successfully before it even started coming down. If you're targeting 1:3, they are still staying in the market for more. But yeah, they'd have got you 1:3. But just imagine you're targeting 1:4 rates. The higher what you target, lower your win rates. Alright. So basically it's just best to work with 1:2. Know your profit because the strategy on zone is already 80% plus approved. So you just work with it and you'll be in profit in the long term as long as you're consistent. Alright. So that's for this example over here. So if you're having another example shortly, which will include an uptrend position, then you having a selling example here. So let's do that quickly. So yeah, we're going to be looking for another example here, and this example we can clearly see that we are currently working with an uptrend because the market is going up, reversing down, up, coming down, up, just like that. You figured out already that this is an uptrend situation. Now, from where we're currently in the market, uptrend, you're supposed to expect the market to come down, go up again by breaking new structure. But this is what the market decided to do over here. So let's check it out quickly. Now, if we keep on checking this out, we see that the market, instead of going up, it came here to form a double top pattern. All right, there's a double top over here which the market formed. Okay, and here we can see a fair value gap position over here in the market. So yeah, upon getting in the market, we can even see before the market continue moving on the 1 hour chart that there's a fair value gap position over here. If I take it the 15 minutes chart, I'll see a clear order block formation there too. Okay, but let me just work with this because there's an order block from here that swept this liquidity over here because you can see there's going to be a buy position here that sweeps liquidity in the lower time frame. Okay, but working with this chart, let me just explain using this fair value gap position and even the wick of the other block at the bottom to explain how it plays out. Basically, from here directly, we can clearly see that the markets will need to reverse into this position here and come down. Remember, we're taking our trades on lower time frame, but explaining here, let me just give you the scenario. So playing it has started getting to our zone. We enter, remember, we enter our trade at the 50%. Okay, let me work with this. We enter our trade at the 50% retracement zone in the market. So basically, we'll enter our trade somewhere around there. All right, and then once it reverses into this position, we'll be having our position activated. So yeah, we're currently in the trade. Now, currently in the trade, we're going to be entering for a sell position over here. So let's get our sell trade activated. So I'll be entering our sell position from here. So taking our take profit to target liquidity can be tricky. So we'll just work with the 1:2 risk reward ratio. We are working with this properly. The 1:2 is going to be a big trade because you are using a huge stop loss on a 1 hour chart. For a good risk reward ratio, you need to go in lower time frame. So working with this property, let's see how to play well on a 1 hour chart. So you can see with just one candle, all right, we got our trade into profits. Even as huge as this position is, we got into a profit. So basically, if you are checking even the pip value of what you just covered, this is 60 pip movement in profit. So we risked about 30 pips for 60 pips profits. So I think that's a lot of money already for those of us that know what 60 pips is all about. Okay, so basically people that stay in the market for more would have milked even down to 1:2, 1:3 or thereabout, depending on how the market played out here. So yeah, so that's how this market rules when you're dealing with the ICT trading strategy. But you just need to manage your risks properly, know how the market plays out, and know how to utilize it to maximize gains. If you learned a lot from this video, do it to like this video, do it to subscribe to this community, and do what to share this video with your friends because we'll update you every week profitably on how the market rules. Alright, I'll be seeing you in the next, but do what to follow us on our WhatsApp group where we'll be dropping free signals and training classes, and also our Telegram community for more. See you in the next one, champ. Stay blessed. Peace.